Shanti Ekambaram is joining us right now to take some questions on the macros. She's President of Consumer Banking at Kotak Mahindra Bank. Ma'am, thanks very much. It's always a pleasure to have you on Profit. Prashant this side. Ma'am, a couple of things. Earnings season is behind us. And I trust you were listening into our earlier analysis on the first quarter earnings, and we'll get to that and get your thoughts on that as well in just a bit. But I just want to start with the big macro tailwind, which is the fallen oil prices. Oil prices are down more than $10 since the time that the new finance minister presented the budget. And it's, of course, certainly helped the finance minister so far. And of course, a lot of moving parts there when you see the translation of the over $10 fall into the fiscal deficit. But everything remaining same, it's actually very, very significant. I mean, it could cut the fiscal deficit by about 12-13% or so. Everything else remaining the same. My question is, while stock markets have reacted quite favorably, bond markets haven't reacted at all. Yields haven't come off at all. They're still where they were. Why is that? Is that because equity markets generally are, they get excited too soon, too quick, and are quick to get disappointed as well? And bond markets, as they generally say, bond market players are a lot more savvy. They're a lot more reasoned. How would you see this, ma'am? Equity markets surging, bond markets not reacting to this phenomenon.
Okay, two things, one, as you rightly said, oil at about close to $100, $101 is indeed significant. On a rough calculation, about $1 is about $1 billion off from our fiscal deficit. So if you say $10 off, it's anywhere between $10 to $11 billion on the fiscal deficit, which is extremely favorable to India. And, thus you can see the equity markets, rallying. Actually, in fact, even currency should have rallied because it has a direct impact on currency because there will be that much less outflow. However, you haven't seen that. 2-3 things I'd say. First, I think there is this uncertainty about the global geopolitical events. While there seems to be some kind of stability but it may be deceptively calm, whether it is Ukraine, you've again seen the bombing in Gaza, and of course the Iraq ISI situation. So I think the geopolitical uncertainty is still casting a shadow. I mean, after all, if you remember, oil was at about 102, 103. It shot up all the way to 110, 112, remained there for some time. And now, surprisingly, in the last 1 week, you see it come off in a major way right down to 100, 101. So I'd say the first thing is that we need to see that this is sustainable. If you talk and listen to many global experts, they believe not only is this sustainable, but it is possible that oil may come down below $100, in which case it is very positive for India macro, and you would see at some stage the domestic indices starting to react. Second, however, if you saw, one of the reasons why there was positivity is that the government had said that they would cut their borrowings in the first half. However, they said that the overall borrowing program of the government remains exactly the same, which means there is no indication while this will reduce the fiscal deficit, there would be any reduction in the borrowing program or the supply of paper as far as the bonds are concerned. Yeah. So I think broadly I'd say these two are and of course, the domestic inflation continues to remain high. Don't forget that CPI is still at 8%, in fact, has come higher. And if it's being very sticky and showing no signs directly linked to vegetable prices. So I'd say it is these three factors that are still keeping the bond markets reasonably range bound, while the equity markets, in any case, were already in a positive frame, reacted favorably to this macro situation. How each one of these three plays out, I think, will determine how it would react. But no question that a lower oil price is good for India macro, would be ultimately good for fiscal deficit, and of course should sort of bode well for the bond markets at some stage, keeping these 3 or 4 parameters in mind.
I mean, actually, a lot of things continue to be turned on their heads, right? If you look at global stock prices, when growth wasn't non-existent in the US, Eurozone, etc., I mean, stock markets around the world continue to do very well. Taper, no problem. Prices continue to head higher. Nowadays, you've got unrest in, West Asia. You've got unrest everywhere. In the US, for example, unprecedented civil unrest in some particular cities, but no real impact. Markets seem to be on autopilot in that sense. Ma'am, just so what you're saying is that the market needs oil to stay where it is for an extended period of time before it starts to recognize the fact, the bond market that is, before it starts to sort of count this in as a given that, well, oil prices are headed lower and they may stay lower. Is that what you're saying? And this is being seen as a more temporary, change.
I said three things, Prashant. One is that oil needs to show stability.
The first
this
one.
Is just about a week old.
Just to focus on the first one. The first of the 3 points you made, ma'am.
Yeah. So I'm saying that oil is just one of the factors. Yes, oil is positive for the macro. We have to see that translate into lower fiscal deficit, lower government borrowing, and thus higher liquidity and hence the yield. So I think it needs a little more stability. Remember, no just one factor moves. There are many factors that move the market, but yes, it's positive, but it's not yet fully there. You need to see it for some time before you realize, okay, this is here to stay and perhaps it is headed even lower.
Good morning, Ms. Ekambaram. This is Anindya from the Delhi studio. Just wanted to get a sense about what is happening in terms of credit pickup. Are you seeing credit offtake going up?
I'd say it is still sluggish, Anindya. I don't think that you are seeing, let me divide it into two parts. I think the retail credit, you have seen a little bit of uptick. You've seen car sales come back. You've seen car financing come back. You've seen there has been an uptick in the home financing. There is a little bit of movement on the small working capital business. As far as the corporate side is concerned, it is still largely refinancing rather than real large new projects being announced. So you're seeing a recycle of refinancing. So it is, I would still say, slow. You've not yet seen a real sort of, a growth pattern as yet. So I'd say it's slow but steady right now. You've not yet seen what you would like to see. And I think it very closely reflects the economic growth. I mean, if you've seen what's been happening, that is still moving very slowly. So I think it is just hugging the economic growth. But certainly at the retail end, you are beginning to see cars, homes, and you're seeing some amount of movement.
So is this a standard pattern that you've always seen when growth picks up? Because usually one sees that, salaries go up, when companies start leveraging themselves a little bit, they start growing, their salaries go up, there's a bit of a wealth effect, and then you see retail participation increasing on the credit side. But this time you're saying that actually the retail end is leading the growth.
See, it's been slightly different if you look at the last 2 years. The last 2 years, you saw that the wholesale side really got impacted by this whole economic downturn, as well as there were a lot of NPAs and companies had actually levered, but there was no equity really in the markets. Now what you're saying is that as the capital markets have opened up, companies have actually raised equity, are raising equity to deleverage themselves. Throughout this entire time, the retail side never really went into stress, unlike in 2008-9. The retail side, you never really saw large job losses. You never really saw stress on the retail side. It remained flat to steady, but it never really went down. Second, I think many people were waiting for the May 16th event. Post that, you're actually seeing an uptick in the consumer behavior as compared to, say, pre-May 16th. So if you look at the combination of factors, the wholesale side is actually coming out of a severe, recessionary kind of a phase, deleveraging themselves, raising equity, preparing for the next phase of growth, while consumer sentiment, because the sentiment is more positive, is coming out and maybe spending a little more and leveraging a little more.
So what the lessons that I get from what you're saying is that probably we are going to see an uptick in consumer durables, auto, growth in that space first, and then industrials.
Let me put it this way. industrials to grow, you need to have a kickstart of the investment cycle. What you have seen in the last 1 month, you've seen a lot of M&A happen. You've seen a lot of assets being taken over, right? You've seen a lot of equity being raised. Companies are preparing themselves for the next phase of growth. So there's always, a lead and a lag. It takes time for this to start showing a sharp uptick. In my own view, the latter half of the year, the second half of the year is likely to be significantly better than the first half of the year for the wholesale sector. Having said that, there has been a lot of refinancing. There has been an increase in working capital requirement that you've been seeing, but it's still slower and steady rather than a real uptick.
So you're saying working capital credit has increased, right?
Yes.
All right. So I'll again want you to focus on that specific thing, because you could give us a cue, which is you are saying that consumer finance, that is seeing an uptick. People are coming and taking loans for homes, for cars, for other personal loans that you were talking about. Would that mean that we are actually going to see an increase in the real estate space, a growth in the real estate space, growth in the auto space first? And when these people start selling, getting rid of their inventory, and they start probably spending a little more, then the industrials, then the cyclicals will start picking up?
There are two different things. Firstly, you have begun to see the movement at the retail end. I repeat, if you look at the numbers on the cars for the last 2 years, if you look at the home numbers, if you look at the home finance numbers, you have seen a movement in the last 2 months. Yeah. So that clearly shows that some amount of consumer confidence has come back. How fast it goes from here, how steep it goes from here, we have to wait and see. But there is certainly an uptick as compared to, say, maybe 6 months ago. On the wholesale side, the investment cycle has to kick in before you start seeing, a significant increase for, let's say, project loans, and of course, then thereafter followed by working capital. Now, that depends on a number of factors, not just consumer uptick, right? It depends on a number of factors in terms of, the investment cycle, the various approvals, the environment, the debt to leverage ratios, and all of that. So that is kicking off much slower. And frankly, the whole infrastructure story has to roll out. I think a lot of it, in my mind, is work in progress. Companies, like I said, are getting themselves into shape. So I think the two will run parallel. The pace of the two can be very different. And it really needs to be see how growth pans out in the next 6 months to see what will pace or outpace each one.
Ma'am, do banks still, what would be the total corporate credit growth at this stage? Would it be 12-13% rate of growth?
Yeah, I think it would be around there. Maybe the industry average would be 13-14.
And retail would be higher. I mean, it could be 17-18% or so.
See, normally you say that bank credit growth, you don't sort of distinguish the two, but retail could be marginally higher than that. You can say that the bank credit growth is around maybe 14-15%.
Okay. Is there a general risk aversion still while lending to corporates? I mean, and I refer especially to what's happened recently, the Syndicate Bank thing. This morning, there's a story about Dena Bank and Oriental Bank of Commerce. Some past things with regards to, the 2G case and things. Some of those things are actually getting highlighted once again as cases which this new government wants to pursue, bring to the logical end, etc. I'm not saying that we kind of are going back to what was referred to as policy paralysis, and nobody wanted to really take a decision because of fear of authorities coming after officials later. But is there general risk aversion still when we talk about corporate credit?
I don't think much has changed in terms of credit has always been, risk assessment rather than risk aversion. So wherever the risk assessment is positive, money is still being put out even today by various banks. So it's really very situational. So I don't think that there is an aversion, but certainly assessment and due diligence perhaps has become much more stronger than even before. And frankly, that is positive for the industry and healthy for the industry.
Okay. Could you tell us, I mean, so, in September last year, September 2013, credit growth had actually spiked hugely. I think some 400, 500 basis points or so. I mean, to about 18% or so. So, what would the second half bank credit growth be like? Because you've got a very high base that you'll be dealing with. Could it drop to sub 10%, the overall bank credit growth?
See, there's no point discussing percentages. It actually depends on, can you tell me what's likely to be the economic growth? I mean, we saw the IIP numbers, right? We all were disappointed by it. I think very important that we see GDP growth really move up. I think if you see the GDP move, a percentage go up, you will see credit growth grow up. Remember, there are three parts to it, right? There is agriculture and allied. Hopefully, with just less than 15% deficiency in monsoon, you would see agriculture, grow, and agriculture at least be stable. So there will be some amount of busy season, as you know, from October that will consume some amount of credit, right? Retail credit, we've seen an uptick in the last 2 months. I'm hoping that will remain. And corporate really depends upon, how we see infrastructure and the GDP growth for people to come back and start investing. So in my mind, the way we see it is that logically, credit growth should be higher in the second half as compared to the first half. But I think there's a lot of factors and a lot of even policy decisions that are awaited to see how this pans out. Suffice to say, second half should be better than the first half of this year. I can't say in comparison to September 2013 because then you're really doing percentages and base effect. But credit growth in the second half of this year should be better than the first half of this year.
Ma'am, what about the move away from fixed maturity plans? I mean, the outstanding there was almost about 2-3% of the total bank credit. Will we see some market share gains? Have we already started to see some market share gains for banks because of that? The shift from that? I mean, that product has been rendered unviable now.
We're not seeing any major shift as yet. Remember, investors always have the option of, pushing back to 3 years to get the indexation and the tax benefit. So remains to be seen. I think a bulk of this action will be seen closer to the end of September. As it stands now, you have seen very, very marginal movement. There have been movement. Many people have rolled over. Some people have pulled out. But the impact has not yet been felt on the industry. I see a lot of it will come perhaps during September and towards the end of September. Suffice to say, individual and HNIs, etc., have the opportunity of rolling it over for a period of 36 months. Depending upon the various conditions that are laid out. And if corporates pull out, they still may have several options that are open to them. So you're not yet seen a big shift on the ground or any major change.
All right, Ms. Ekambaram, I want to get your sense of what you think the Modi government's focus is going to be. But before that, I want one question out of the way. The cleaning of house that is happening in the PSU banking space, where the CBI is going, which Prashant was referring to just a short while back, many of the companies which have, PSU banks have exposures to, also some of these loans are given along with an entire consortium where private banks are also affected. Now, the private banks might have done their risk assessment, but when the PSU bank part of that loan collapses, then are private banks also going to be affected by this cleaning of house?
Now, if a credit goes bad or if a company has to get into stress, all bankers in the consortium are likely to be impacted, right? Because they are all in it together as a consortium. So I think what you have to distinguish as to what do you mean by cleanup. If you're talking about companies who have got into stress on their credit, then all the banks who are a part of the consortium are likely to get impacted. So any company whose credit is likely to go into stress, if they have a consortium which combines only PSU and private and foreign, all of them are likely to get into stress till they actually work out the cash flows, the business cycle, and of course how the loans are going to get serviced.
No, what I'm trying to focus on, and I'm trying to understand this, is because if one looks at some of these investigations that are taking place, of course, the trigger is the fact that the company is under stress. But the point is that in these cases, the allegations being made or the investigations that are being done into is the bribery, that some bribes have been paid to PSU bank officials and loans have been given to these companies at less than market rates. Now, you might have done your assessment, or a private bank, not necessarily obviously Kotak, but a private bank might have made an assessment, charged a certain rate and got into a consortium. But when that loan which has come from the PSU bank side starts collapsing, will some private banks start facing a problem even if the assets are not under stress?
No. Any credit that goes bad is related to underlying business getting under stress. It has nothing to do with rates. So even assuming there have been differential rates that are charged, ultimately credit depends upon, is the business of this underlying company running smoothly? Are the cash flows coming out? Are the cash flows sufficient to repay the debt? A 1% or a 2 percentage point differential in interest is not going to impact credit. Credit gets impacted by the underlying fundamentals of the company. So if the underlying fundamentals of the company go bad, or have not been correctly displayed for whatever reason, we have seen many such things, and credit gets into stress, it does not matter whether the bank is a domestic private sector bank or a public sector bank or a foreign bank. So everything depends on the underlying credit. Interest rates have very little impact beyond a point.
So you're saying that any of these investigations which are taking place, because what we are picking up in Delhi is that criminality is also being investigated. So the Modi government is trying to clean up possibility of criminality. So even if the company is actually not under stress or the loans are not under stress, the fact that there was a corrupt practice is being investigated, and in some cases, as we have seen, that even the company's management is being targeted. Now, if that company's management starts failing, or the management is booked for criminality, does the loan get stressed then, or you think that some other management will come and take it over as long as the assets are fine?
If the underlying business, I repeat, are fine, the cash flows are fine, the banks have the choice of putting in place a new management, it can be business as usual. If the underlying business itself is fundamentally poor or was made out to be better than what it is, then credit gets under stress. It is actually fundamentals of the business. Management can be changed, new people can be brought in, right? The value of the underlying business, where has the money gone, end use of money, and the cash flow cycle is what determines whether the credit gets into stress or otherwise.
Generic question, just trying to understand this. So take Bhushan Steel, for example, right? So it's got, I'm taking a specific case because here's a company which has got about 4 million tons in operation, or near 4 million tons in operational steel capacity. It's commissioning another 2 million tons or so. It's running a little behind schedule, 1.5 odd years behind schedule. People in the steel industry that I've spoken to have a favorable view of what Bhushan Steel produces, about quality and things like that. But the promoter now is under the scanner, right? I mean, being investigated by the CBI. And what happens in a case like this? How does a bank, I'm just asking for a general view, how does the bank view this? What is the road for resolution here, something like this, in this case?
So I can't comment on Bhushan Steel specifically because I have no idea about the financials and the fundamentals. But if you take it as a generic case, if the management is under scanner, the banks have a right to appoint a new management. And then the new management really takes over. The bank has a right to put, the banks perhaps in their agreement, I'm sure, have a right to appoint a nominee director or whoever to look into the affairs of the company, and they've got to get into details. If the underlying plants are operating, if the capacity is there, if cash flows are being generated, then the bank should not have a problem. They just need to make sure that all the cash flows flow into the banks, the cycle is there, the goods are moving, cash flows being generated. So they can change the management and they can bring about a greater oversight into the operations of the company.
Would banks want to lend more money to?
This is true for any generic case.
Okay, but banks would So once they have their people on the board, then it continues to be treated as a standard asset. If extra money is required to tide over this this crisis or issue, I mean that can be lent.
It's a very specific case, no? How do you expect me to answer that?
I was hoping that you would get specific, but Kotak doesn't have any exposure, right, ma'am? Since we're on the subject.
No, none whatsoever. None whatsoever.
None whatsoever. There's another. I think there's another case of Winsome being the second largest defaulter. I think it's in one of the newspapers. Not a new story. I mean, it's been around for a while now. So lots of these things now coming up again. Anand, I think has a question. Anand.
Just wanted to. We've taken too much time of Ms. Ekambaram, and thank you so much for joining us, ma'am. I just wanted to come in and thank you. I think last time we were lined up to interview you on budget day, we had a problem with the link, but you waited, and I want to apologize for that, and thank you for coming back again. Thanks a lot.